apart the stock market and put it back together so that it makes sense for you. Well, Ben Bernanke, chairman of the Federal Reserve, he was back at it again, speaking today before the National Association of Business Economics. He told them that, the economy is still growing very slowly. Unemployment rate coming down from 9.1% to 8.3% doesn't really fit with the slow recovery. We may have to go in for some more QE, he said. Well, stocks loved that. Ben Bernanke doing all these extraordinary monetary moves is a little bit like Vincent in the movie Pulp Fiction. You remember that when he took out Marcellus Wallace's wife for a night in the town, and a little too much partying led to a kind of a coma situation until they got an adrenaline pen and pounded it right into her chest, and she got up and recovered. So did the economy, but it looks a little bit like Uma Thurman's character in Pulp Fiction. Nonetheless, quantitative easing does wear off. The first round was back in 2009. The Fed started buying government bonds. Look at the stock market recovered nicely. Here's where Ben Bernanke announced his second quantitative easing in Jackson Hole, Wyoming, back in September of 2010. Wahoo! Everything went to the sky, commodities, stocks, and this wore off. Then the Europeans stepped in and helped us out late December with their quantitative easing called Litro, as appropriate for a European name. But for today, stocks loved the hint that Bernanke might be on the case to provide more liquidity, like we don't have enough in the economy right now. S&P 500 up about 1.38% today. Here's the SPY that tracks it. We're at 2.5, almost 3-year highs on that index. Take a look at here. The breadth, it's not too bad. Doesn't stink at all, as a matter of fact. When you look at the market, you want to see what is underneath the surface. You want to see how many shares are participating in the rally, how many companies, how many stocks. Look at here, NYSE. Today, you had advancing issues, 74% of them. So you had a 3-to-1 ratio of advancing to declining issues. Similar thing over on the NASDAQ, 74 to 23%. What this shows is that most stocks are still participating in this rally, and it's not some hollow thing on thin ice that could crack quickly. What you want to see is this line coming down before you want to get short the market. And as you can see, over the last 4 months, the AD, the advanced decline line for the market, the S&P 500, is still trending up, and that's bullish for stocks. Well, let's take a look now. A lot of stocks at new highs. A lot of them. You can shoot fish in a barrel. Here's Chipotle Mexican Grill. You probably had one of their fabulous $7.50 or maybe $8.50 where you live, like here in New York. Burritos. They're delicious. They're expensive. The stores are great. The stock, look at this. This has been a moonshot since, early this year, or right around Christmas time when the Litro took effect. 320 to 424 in that stock. 30% rise in shares of Chipotle. Let's take a look. Is it a bit of an overstuffed burrito? Looking for $8.72 per share in earnings this year, analysts are. That's the December 2012 full year. That gives it a 48.7 PE ratio. You can pay up for a stock if it's growing fast. It's growing fast, but not as high as the PE ratio. 28.7% expected increase in earnings per share last year to this. Sales growing a bit slower, 21.3%. That's the forecast anyway. So when you have the EPS growing below what the PE is, you want to think twice, but boy, that momentum in Chipotle sure has been big. Look at Apple. Apple tagging some new highs, 606.98. Look at, how about them apples? Driven by the sales of the new iPad. You got an iPhone 5 on the horizon. You got Apple iTV. How is Apple looking as far as valuation? Expecting $43.90 per share for that stock, which is now over $600. But that doesn't come out too bad for a PE. 13.8. The overall market's about a 16.5, 17. Apple, 13.8 times earnings. Earnings growing at 58%. If you believe those numbers, and no reason not to right now, but if you believe they can't grow in perpetuity, you might have a problem. But those numbers show that Apple is still quite a juicy stock with a nice future. Had a great article today, though, from Martin Sosnoff, money manager who contributes to these pages at Forbes quite a bit. He said that Apple should take some of that $98 billion it's going to spend part of on buybacks and dividends and invest it in different companies the way that Warren Buffett does. Interesting thought. Read Marty. Priceline, boy, woo! From $450 to $735 in just about 4 months, even without Shatner. He got pushed over the side in that bus, Priceline, what are they looking like? Valued at 23 times $31 per share expected in 2012, growing at 33% a year. Priceline at new highs, not totally new highs. Back in 2000, it actually, or 99, it traded as high as $935. It's still looking cheap. Priceline, look at it. Intel, boring old company, Blue Man Group. Remember those great ads with the, I think it was the Celeron processor? Love those blue heads, and it's a great show. Intel tagging a new high, $28.19, still getting about a 3% yield in the stock. Not a runaway valuation, okay? 11.7 times earnings. Earnings are growing flat. Revenue up about 4.7%. So Intel, not intuitively cheap, but the consistency of earnings and the dividend is certainly nice. Qualcomm getting a big boost. It's of course inside of the iPhone 4S. It's in its LTE chips are in the new iPad. It's got a nice little star hitch to it with Apple. 68.59 the new high in Qualcomm. Take a little peek at Qualcomm, looking for $375 per share. Gives it a PE ratio of 18.3 times this year's expected earnings, and they're growing at 17.2. That might accelerate. Qualcomm still looking fairly cheap at its new high. And then finally, the credit card companies, Visa and MasterCard, these guys make a fee between about 3 and 6%, maybe not as high as that, for processing transactions down at the gas station, down at the store, whatever. Visa trading at a PE of 20, growing earnings at about a 19.4, so you have about the same PE and EPS growth rate. Not expensive looking stock in Visa. MasterCard, a similar situation, but a little bit less attractive on the valuation. PE 19.8 and EPS growing at 12% a year for MA. But of course, the stock chart looks lovely. Lots of stocks at new highs. Watch the advanced decline line because that's when the market will give you a little bit of an advance warning that it's going to head south. But at this point, it doesn't look that way.